Fintech was supposed to be the future, the big disruptor. But what happens when these billion-dollar ambitions come crashing into cold, hard reality? Well, today, we're going to try and reconcile the hype with what's actually happening on the ground.
I mean, this quote just nails it, doesn't it? It's not just clever, it's spot on. One day, you're watching a corporate power play straight out of Succession. The next, it's a crazy, high-stakes bet that feels just like The Big Short. And yeah, sometimes it's straight up inventing Anna. This is the drama of fintech right now.
So to really get our heads around this, we're going to look at three different stories. We've got a major partnership, a pretty surprising funding round, and a cautionary tale of fraud. Think of each one as a piece of a bigger puzzle, telling us something really crucial about where fintech is today. All right, first up, let's talk strategy. Because this isn't just about some new feature getting rolled out, it's about a battle for control. We're looking at two huge players, Intuit and Affirm, and what their new partnership really means. So, on the surface, this whole deal looks pretty simple, right? A convenient new feature for users. But the reality is way more strategic. It's like an iceberg. What you see is just the tip. Underneath the water, this is all about building a defensive moat, a fortress designed to keep customers locked in and competitors locked out. Here's the deal in a nutshell. If you're a small business using QuickBooks, you can now let your customers pay you in installments using Affirm. It sounds great for your cash flow, right? And for the companies, Affirm gets access to millions of businesses, and Intuit gets another sticky feature for its platform. On paper, it's a perfect win-win-win. But, and this is the big question, is this genuinely useful, or is it just fintech bloat? Are we actually adding real value here, or are we just cluttering up perfectly good accounting software with a bunch of options nobody really asked for? And this really gets to the heart of Intuit's strategy. It's this concept called platform gravity. The more of your financial life that you run through one platform, invoicing, payroll, and now even how your customers pay you, the heavier that platform becomes. It creates this whole ecosystem that's just incredibly difficult to leave. So the real takeaway here isn't about a pay later button. It's about owning the single most critical moment for any small business, that moment when money actually changes hands. It's a pure power play to control the entire workflow from start to finish. That whole idea of strategic reality leads us straight into our second story, the financial reality. What happens when the story a company is telling doesn't quite line up with the numbers? And to get into that, we've got to look at the neobank Varo's latest funding round. So get this, Varo just raised almost $124 million. Now, in today's really tough market, that is a number that makes you sit up and take notice. But it also raises a massive question. Because here's the thing, Varo's growth has been slowing down. So why on earth are investors pouring all this money into a company that seems to have lost some of its steam? What are they seeing that we're not? Well, this brings us to a really fascinating idea for the times we're in, the belief maintenance era. This isn't about funding crazy, explosive growth anymore. No, this is about something else entirely. It's about protecting the massive bets that investors have already made. For Varo's investors, this is a calculated gamble. Step one, you've got to protect their most valuable asset, which is Varo's national bank charter. That's a huge deal. Step two, keep the dream of a future sale or an IPO alive. Step three, do whatever it takes to avoid the terrible press of a down round, which basically signals failure. And finally, step four, just hope. Hope the market gets better and the investment eventually pays off. So the takeaway here is incredibly sharp. This investment isn't really a vote of confidence in some amazing new growth spurt. It's more like investors are paying a premium for more time. They're paying a patience premium. And that leads us to our third and final story. And honestly, this is where the reality gets the most serious of all, the ethical reality. This is what happens when the one thing fintech absolutely cannot survive without, trust, is completely shattered. The story, unfortunately, might sound a bit familiar. A celebrated founder, featured in Forbes, backed by some of the biggest names in venture capital, is now facing federal fraud charges. The allegation that she systematically lied about her company's revenue to keep the investment money flowing in. And this right here is why one person's alleged crime matters to everyone. In finance, trust isn't some fluffy marketing slogan you put on your website. It is the literal foundation of the entire industry. It's the promise that the numbers are real and your money is safe. And without that, the whole thing just collapses.
So when that foundation gets a crack in it from a big, high-profile case, it creates a blast radius. Suddenly, for every other startup, investors' due diligence takes way longer. Raising money becomes more expensive. Regulators get nervous and start tightening the rules. And, maybe worst of all, the honest founders have to work twice as hard just to prove they're legit.
The really crucial point here is that the consequences go so far beyond just one failed company. A single act of alleged fraud, well, it acts like a tax on the entire industry, making it harder and more expensive for everyone else to operate and innovate.
And I think this is the perfect way to put it. In fintech, the negative effects of a lie compound faster than any interest you could ever hope to earn. It's a debt that everyone in the ecosystem ends up having to pay back.
So we've looked at three really different realities today: strategic, financial, and ethical. Now, let's pull it all together. What is all this telling us about the state of fintech? We've seen the strategic reality, where a simple feature becomes a fortress. We've seen the financial reality, where a big investment is really just a lifeline. And we've seen the ethical reality, where a good story hits a hard wall called the law. And that, right there, is the one single, unbreakable rule that connects all of these stories. Doesn't matter how clever your strategy is, how high your valuation gets, or how compelling your narrative is, eventually the books have to balance. The truth always reconciles. Which leaves us with a really critical question. And it's not just for the fintech world, it's for all of us. In an industry that runs on hype and ambition, who's actually responsible for making sure the truth gets reconciled? Is it the founders? The investors? Or is it maybe us, the customers who buy into the dream? That's the question we all need to be asking.